Welcome back, ladies and gentlemen. Today we have the pleasure by being joined by Joseph Hogue from Let's Talk Money, the Bowtie Nation, in this kind of insane market where, like I was saying, things seem almost terminal at this point. People are starting to lose their minds, whether it's crypto, real estate, I mean, even the precious metal markets, right? But first and foremost, welcome, sir.
Kyle, thanks for having me. Great to be here. Had to take off the bow tie, go a little informal, just to see if I can get everybody to relax a little bit on this market, right?
Yeah, I'm too dressed up for this one. I think everyone needs to just kind of maybe crack a beer or something and take a break here from the markets. Come back in a year or two. But that's kind of what I want to talk about here. I want to get into more or less strategy, right? I think most people are finding solace in listening to how other people are kind of adjusting to this market, especially kind of this risk-off insanity right now. First and foremost, do you want to talk about the levels in the market? I mean, you're doing a bunch of different stuff with bonds, cash. You're still kind of cost averaging, keeping your portfolio at bay here. But what is your current thought on where you think the market's going to go? We got the Fed meeting today. A lot of people think we're going to get a relief rally from this, probably a 0.75% basis hike. What's your thoughts here?
Sure. Well, I think it does help to look for levels in the market to where you're going to invest that free cash or any available cash or even do some rebalancing from your bonds from maybe some of your other assets into stocks. Gives you a little bit more certainty, right, in such an uncertain market, and it really does help reduce the stress in your investing and how you look at the market. So we can talk about that. What I'm doing right now is really kind of just taking a backwards view of the price to earnings ratio, right, the historical PE ratio over time, see where that's been, especially during recessions, and where would that make good levels to invest in this market as we do most likely head into a recession in 2023, right? It's very difficult to see the Fed not pushing us into a recession. Um, and I think they do, they do end up doing that. So if you look at prior recessions, actually Deloitte has some really good data out. The average fall in corporate profits for the S&P 500 companies was 20%, right? 20% fall in earnings per share for S&P 500 companies over that period. So you can kind of get a sense if analysts right now are expecting about $213 per share for S&P 500 companies this year. 20% off of that would be about $184, right? So if we are reporting $184 next year in S&P earnings, then you can kind of take those PE ratios, right? Over the past 10 years, average has been right around 20, maybe a little bit higher. 17 has been really good if you can get stocks at a 17 price to earnings ratio. 14 has been great, right? Anytime the market has been at 14 times on a price to earnings ratio, you've made really good money. So I'm just kind of taking those levels, looking at the S&P 500 right now, and kind of making those levels my markers for when I invest. Now, understand, I'm just looking at the S&P 500 as a marker for when to invest. I'm not necessarily investing in that. I've still got my own favorite growth stocks and dividend stocks and long-term stocks that I'm going to be investing in at those levels. I'm just using the S&P 500 as a marker. So
Yeah,
if we're looking at something like maybe a 3,400 on the S&P 500, right? That is actually the Morgan Stanley call for the level by the end of the year. It would be 30% down from the peak. The peak was right around 4,800 on the S&P 500 at the beginning of the year, and it would actually be about an 18.5 times that 184 earnings for next year, right? So maybe still a little bit on the expensive side. And actually, we do see over the last 90 years, since 1930, the average bear market or the average stock market crash was about 28 to 30%. So it's right around there where the average was. Now, some of those bear markets were skewed low, a little bit lower, a little bit less because they weren't followed by a recession. Actually, the ones that were followed by a recession, the average is a little bit higher, of maybe about 35 to 45% loss. So I would be looking at if stocks to fall a little bit more than that if we are heading into a recession. So we look at other levels here. 2,900 on the S&P 500 would be about a 40% down from that peak, and that would actually be about 15.8 times. So right around that pretty good level, right? Further down, 2600 would be that 14 times price to earnings average. That'd be about 45% down, and that would be really where you want to be. You want to be all in on your investments there. Now, of course, there's variables here that you can't know. We won't know until they're over, like what our earnings actually going to be. Um, like I said, the average is 20% down from during a recession. That would be right around 184, 185 times for the S&P 500. And right now, the S&P is right around 3,900, right? It's right around 20% down so far, which isn't bad. If we do look at history, 20% down for people that had invested when the S&P 500 hit that bear market territory at 20% down, they've made generally about 70% on average over the next 5 years. It's about 11, 12% annualized return. So it's not bad. Bear markets generally last between 9 months to 9 to 12 months, right? So right around a year. The bull markets have been about 54 months, so quite a bit longer. What I like to tell people is really you need to change your perspective on the bear market, right? A lot of people they love investing as stocks go up, but then they panic and they sell out of their stocks and they leave the market. They stop investing, as stocks go down. But these are the best prices you can get. These are priced, stocks at a discount, and you're going to make money if you just keep investing.
Yeah, I think that's the challenging thing, right? Because everyone's kind of readjusting their risk tolerance. I've been selling quite a bit of my stock since the beginning of the year, which ended up working to my favor, but I didn't just pull it into cash. I've been kind of just allocating it toward different index buckets where I think there's going to be less volatility for the near term, whether it's those dividend ETF or the aristocrat stocks. I mean, even the Canadian side of the border has been very generous to us. I'm surprised the Canadian markets have been doing so well, but now that real estate looks like it's going to correct and we're seeing oil, when it has its day, considering Canada's mostly a commodity market, who knows, maybe we could see that start turning the other way as well. I was just looking at the PE on the S&P 500. I think it's sitting at around 19 right now for but the forward PE is getting back into that median range of I think 15, 16. I have to double check on the forward, but nonetheless, small caps as well, right? I mean, small caps right now are historically at insane lows for their price to earnings multiples, depending on where you're playing around in that. But from maybe I'll roll back a little bit because you did mention bonds, cash. I mean, you've talked pretty aggressively. A lot of dividend investors are looking at I bonds right now. I mean, I've been looking at GICs, and with interest rates going up, I mean, you're seeing these guaranteed investment certificates pay out anywhere from 4, 5. Some of these bonds are getting upwards of 10%. What's your thoughts on those right now?
Sure, those savings bonds are some of the best investments you can make right now. Sure, you're locked in for a year on the treasury on the savings bonds here in the U.S. and I'm sure you have some kind of restrictions there in Canada as well. But we're going to need that kind of protection for at least a year, right? The Fed is just starting its rate hikes. Probably will do that 3/4 of a percent today, and they're expecting 3.5% by the end of the year, which would be from starting from basically zero at the beginning of the year, which is a ginormous move in interest rates over just 1 year to get to 3.5%. So they're just getting started. We're going to need that kind of protection because the stock market is going to be more volatile, and I think getting upwards of a 10% return on anything guaranteed is just unheard of. It's a great way to kind of protect that money, get a return on it, and hold it aside until you do reach some of these levels and you want to invest in. It's a great alternative for bonds. I pulled a lot of my money out of those longer term bonds last year because of the outlook for interest rates. The short-term bonds, I still am in some short-term bonds, something like the Vanguard short-term bond ETF, the ticker BSV. Since it's a short-term bond fund, the duration on it is shorter, and it's not going to fall quite as much when interest rates rise, right? I think the BSV is down something like 5.5% so far this year, which sucks. You're not supposed to lose money in bonds, but it has protected you from a 20% drop in stocks in the S&P 500. So it has still protected some of that capital, and served that purpose.
Yeah, it's really intriguing just because it's so weird in a time when my family friends start calling and they're like, where do I put money? And I'm like, well, what's your risk tolerance? You're like, how much volatility can you withstand, right? Because I mean, it's just crazy how much everyone's kind of losing their marbles here. But for me, I'm just putting a list together, as I'm sure you are, and you kind of just briefed on it there. What kind of stocks are you looking at? Are you into the big kind of tech companies? I mean, I love the indexes, but I just can't help but see Google as an opportunity here. I mean, I was a big proponent of the Facebook, but now that all these stocks have have kind of leveled out. I'm kind of just looking through them, and I was in Tesla for a bit, but when we're talking about values, Google's kind of a steal for me here, unless Apple really decides to fall off a cliff. But are you kind of just putting a little, compiling a list? Are you into small caps? What are you looking at?
Sure. Well, I mean, stepping back onto what we're talking about risk tolerance, I think having that formalized strategy is so important, so powerful. Writing out, okay, when you're going to start investing some of this cash and some of these other, rebalancing some of these other assets at these different levels, because it takes the guesswork and takes the market timing really out of that strategy. You don't have to. I see so many investors just watching the market every day, stressing out, and wondering when to invest, wondering if this is the low, if this is the bottom, and they end up just pushing all their cash in, all their chips on the table almost immediately. And of course, the market keeps falling, and they keep losing money. This way, you've got that formalized strategy. You're looking for those markers for points when you're going to invest that cash. And it just takes the guesswork. It takes the stress out of investing. So definitely, something I think a lot of investors need to be following. As far as what to invest in stocks, I'm following kind of a barbell strategy right now, with very heavy on the extreme. So very heavy on the one side with so about half my portfolio in cash, savings bonds, those very risk-free assets
Oh, wow.
and money-like assets, and then the other half is in growth assets, right? So as the when the market does rebound, then those growth assets, those growth stocks are gonna rise the fastest. For that, I'm still looking at some of these growth stocks that were at just insane valuations last year that I couldn't bring myself to jump in with the rest of the herd, right? It's trading at 20 and 30 and 40 times on a price to sales basis. But they're still, and they've come down, and they're now actually in value stock territory, right? A lot of these growth stocks that we were looking at last year, the pandemic plays and the virtual plays, things like that, are now trading at 3 and 4 times on a price to sales basis, which is very low for any company growing their sales by 20 and 30% a year. Right. So what's changed with these is not that they're not growth companies. You've got companies like Teladoc, the absolute leader in virtual healthcare, SoFi Technologies, which is a great fintech company. You've got companies like that are still booking those 20 and 30% year-over-year sales growth. They're still leading those changes in those industries, and yet not they're no longer overvalued. They're no longer growth stocks, but they're growth companies. So those are definitely, I think, ones that investors need to look again at. I know a lot of investors, they immediately look at the price chart, see that 60, 70, 80% drop in the stock, and they kind of get shell shocked. They step back and they say, no way, this is a bad investment. Well, yeah, it was a bad investment if you bought it at 20 or 30 times on a price to sales basis. That's just ridiculous. If you buy it now, though, at a 3 or 4 times price to sales, and you get a stock that's going to produce 15, 20% annualized returns over the next 10 years, that is undeniably a good investment. That is a good stock.
I'm gonna have to say you're a lot more conservative than I am. I think I have that same problem most investors have, where I have to be all in the market at all times, because then I kind of get more stringent in my life and find things to sell, and I start just kind of losing my mind. And I think I become more frugal that way. When I have cash laying around, I think I get more antsy. Actually, I think I'm sitting on more cash now than I ever have, but I think that's for tax reasons. My corporate year end has finally come through, and I'm just trying to figure out what the government wants. But yeah, those are interesting picks. I mean, those are kind of a lot of the broad view. I mean, it's intriguing that at least you're kind of diving down into that realm of where you're seeing those 60 to 80% corrections, which is something that I keep advocating toward too. But it's such a fun time just to be looking at just the skew of different stocks right now and how hated they are, and talking about how hated some sectors are. What are your thoughts on crypto here, man? I'd love to get some insight on that from you.
Sure. There, crypto, just like that growth stock universe. I think with crypto, there are going to be a lot of coins that are just going to go away. A lot of coins that served no purpose. But there is still fundamental value in the blockchain technology, in the blockchain, how it's being used in different industries like healthcare, records management. A lot of these industries really changing how the process works in those. So blockchain technology is here to stay, and it's only growing in usage. And to use that blockchain technology, we need the coins associated with it, right? So the largest coins being used in those, or the largest blockchain platforms, or blockchains like Bitcoin, Ethereum, some of those coins aren't going away because we need them to verify the changes in that blockchain, right? In that online ledger, that spreadsheet. Okay, so those coins aren't going away, and if they aren't going away, then they'll live through the same boom bust cycle that we've seen before. We've seen in stocks for decades, and they will rebound. Actually, I think Bitcoin is now down about 70% from its high of last year. It was down 85% from the peak in 2017 to the final trough there. So maybe it's still got a little bit further to go. I wouldn't think it would go too much more than maybe 15,000 at the most.
Yeah.
But it is something that not only is necessary in that verification of the blockchain technology and of changes in there, but there are a lot of other uses that these major coins are being used for, as far as international money transfers, bank transfers. Very much a new era in financial transactions. So I'm invested in Bitcoin and Ethereum. I've also got some Polygon because it's a kind of a second layer Ethereum that's doing really well. But yeah, I mean, it's just one of those things you just have to live through it. I think talking about that cash discipline, right? And it is always tough to have cash in your account. You see these bargain basement prices. You see stocks coming down, and you want to invest. You want to go all in, and it's hard to have that discipline to where, yeah, you have that plan, you stick with it. Okay, you say, I'm not going to invest any more cash until the market gets down to 30% down to 3,400 or down to 2,900. And I can't say that I've been, perfect with it or even that good with it sometimes. I think most of the time, discipline comes from pain, right? And, I've been investing since 1999, which was a great year to start investing because we know what happened the year after that. So I can relate to a lot of the people that are just starting investing over the last couple of years. And I've lived through, I've made a lot of those mistakes and have had a lot of that pain. And that's only how I've been able to kind of build up that discipline in saying, hey, you know what, I need to wait. I need to wait for these levels to invest that cash because the market could go quite a bit further.
Yeah, and it's intriguing too, right? Because when you look at people like Michael Saylor, I don't know if you've been kind of paying attention, because I love listening to people like Kathy Wood, Michael Saylor, when their stocks are just tanking or crypto's tanking, because they come on and they act a lot more calm than I think they're probably feeling inside, considering how much leverage they actually have into those specific sectors, considering there's been a lot of talk about Michael Saylor's margin hitting, 21,000 Bitcoin. I don't know how much of that is true. Kind of got to take the media with a grain of salt, but it'll be neat to see, because that's what's leading to the perpetual sell-off as people continue to just kind of get margin under control. But crypto's going to be crypto, man. I'm in it just as much as you probably are. I see the value of the technology. I've still been buying it down here. I want to get more aggressive, but like you, I just want to wait just to see, just do little buys here and there as we kind of keep hitting these new lows. But finally, what's your thoughts on the general real estate market? Because I know you're big into REITs. REITs have been a huge proponent of my portfolio for a while, and this year was the first year I actually started taking a lot of those REITs off the table with Stag, MPW. I sold them at not a loss, but I was kind of annoyed at how much they dropped, and then I sold them and they dropped a heck of a lot more after the fact. I'm still holding a few, but I'm expecting, with interest raising environments, unless they have really robust balance sheets, you want to be real cautious depending on how overzealous they got in this market boom. But what's your thoughts on REITs, real estate? Love to get some insight there as well.
Sure. Well, started my career in commercial property as a commercial property analyst, so it's always going to have a special place in my heart, that investment. And two different markets, right? Residential has been just bid up into the stratosphere, and will probably come down here in the United States. I understand it's already coming down quite a bit there in Canada. Commercial property though wasn't quite as bid up over the past 3 or 5 years. So I don't expect any kind of a crash. The leases are generally longer on commercial property. Tenants stay longer because that's their company headquarters or manufacturing, things like that. So it's a little bit more stable, I think, than the residential space. I would be looking to the longer term kind of a trends for that. Basically, picking up some of those long-term trend forces. Those kind of properties around that at a discount, right? So you've got things like data centers, you've got things like medical, medical space, medical properties, things like that have traded a little bit more expensively over the past couple of years, but are now starting to come down. I actually do like MPW in that space. Sabra Healthcare is also another good medical property trust. Stag has always been one of my favorites. I am a little worried, a little bit concerned about the industrial space, just because there was so much overcapacity. Through the pandemic, Amazon rented so many spaces, so many e-commerce e-commerce companies needed so much more industrial space, and now that's obviously coming off. So industrial might be a little bit weaker over the next year or two. It has been really strong, and I expect it'll continue to be strong in the future. So I still like Stag, but yeah, MPW is a really good one, I think.
Yeah, with Stag, it's interesting because their balance sheet's pretty good, but it's just, I was watching Jeremy at Financial Education thinking that logistics centers are going to be like one of the biggest bubbles. He was driving around Phoenix, Arizona. Amazon kind of slipped in there that they're canceling something like 10 million square feet of warehousing. Everybody went into oversupply when you're talking about, just trying to make sure in the supply shortage that you could order enough. So people were getting 30-40% more warehousing just to have that extra space. And then all of a sudden it's like it halted at once. So there's just millions, tens and tens of millions of square feet of just Amazon, all these other companies that are just halting all these buildings right now. So it's going to be intriguing to see where the cards kind of fall out through the devastation across the real estate market. I'm really short real estate when it comes to like fix and flipping, volumes drying up. Those guys' stomachs are falling out their guts right now because they just, as soon as volume dies, right, they're terrified of their margins getting hit as they get stuck on these properties for months, depending on where they're at. But finally, man, just to finish up, what do you think investors should be paying attention to? What kind of solace can you offer here? Any advice that you'd give just on the way out? Give people some hope.
No, I think I'd go back to that idea of you really do need to change your perspective on bear markets. Bear markets, really investors, I think, counterintuitively need to flip their perspective. They get so aggressive, so excited in a bull market, buying as stock prices go up, but you never know when that's the peak. In a bear market, at least stock prices are going to eventually go higher than that where you bought it, because stock prices eventually will recover, enter a new bear market, and you're going to start making a lot of money. Like I said, even someone that historically would have come in now at the S&P 500 down 20% would have made on average 70% over the next 5 years, and even more so if you wait for some of these little bit lower levels. So definitely, use that perspective, pick up stocks at a discount, use that strategy to where you're disciplining yourself and not stressing out trying to time the market every single day. Because it really is the best time to invest. Keep that habit of investing money every month, even if you're not putting it in stocks. Just basically let it sit in cash or some other safe assets in your account. But keep that habit of saving, because so many people they stop investing. They have that money sitting in their bank account, and their expenses just tend to rise to meet that, right? So their expenses go up, and it makes saving later on so much harder. I always love to give the example of the analogy of Amazon, right? Amazon went public in 1997, reached something like $100 a share very quickly there in that dot-com bubble, and then of course when the bust came, then fell down to less than $6 a share, $5.60 a share in 2002. If you would have bought it at those bargain basement prices as the market was coming down, if you would have got it at $6 a share, just recently before the split, it was up something like $3,000, $3,500 last year. That's a 50,000% return. Okay, $1,000 in Amazon in 2002. If you hadn't been scared out of the market, panicked out of the market, and you had kept your focus on these growth stocks, these companies changing the world, then you would have had $500,000 just from that $1,000 investment. So change your perspective, because these are some of the best times to invest.
Yeah, and I think you made a good point earlier on too, that the consecutive years following a bear market tend to offer much better returns if you can just stomach through it, right? But on that note, I definitely appreciate your time, Joseph, and I want to pass the question off to the viewers. I'd love to know what you guys think about all this in that comment section below. Go check out Let's Talk Money. I'm going to leave the link down in the description there as well. But on that note, stay cool, stay awesome, and as always, I look forward to catching you in the next one.